Hey traders, Marcello here, founder of the Day Trading Academy. Welcome to my actual office here in my home in Colombia. Today we're talking about high frequency trading. Now, many of you guys probably understand the term. You probably have heard of it because recently there was a book by Michael Lewis, Flash Boys, that blew this kind of into the public domain. Essentially, what's happening is there are robots or algorithms, right, that have mathematical formulas that have faster connections to the exchange than all of us and are able to trade in microseconds or milliseconds much faster than we do. There's even some front running occurring. Front running is essentially when they see our order, they buy it and then resell it to us, and that difference in price, which may just be, 0.01 cents or 0.00001 cents, that difference in price is a gain for them and a loss for us. Now, one of the things to understand about high frequency trading is the number of high frequency traders is very small in the grand scheme of things, making up just a very small number, 5-10%, less than that most likely. But they account for over 50%. Some reports say that they account over 70% of the actual volume in the market. So when we're trading, if they are front running, they're able to calculate and produce and process information a lot faster than we are, manipulating the price even further. Now imagine, for example, some of you that have pension funds or 401ks, for example, or Roth IRAs, and you're invested in certain places. When somebody needs to make a purchase of a stock, we're going to be affected almost 100% by an algorithm or a robot. If you guys remember what the flash crash was, if I'm not mistaken, it was in 2010. It's when the market literally just dropped 200-300 points and then literally just came right back. That was literally cause of the robots or the algorithms. Now, a lot of people say that high frequency trading, or I should say the people who high frequency trade, they say that it's good because it provides liquidity in the market, but they're not essentially adding value to the actual volume, even though they account, over 50-70% of the actual volume on the exchange. All they're doing is taking the information and buying and selling in a fraction of seconds, sometimes in microseconds, faster than we can blink the eye. And a lot of times they're front running before us. They have connections that are literally 1 second faster, a millisecond faster. Their cables to the exchange are shorter, which means that they can transmit information a lot faster as well. And a lot of times now they're using lasers. So they'll have, on a cell phone tower, for example, they'll pay millions of dollars from, to be able to get a faster access from one laser to the other, to be able to get faster access to the exchange. So in a nutshell, that essentially is what high frequency trading is. It isn't necessarily good for the exchange at all, especially if you're more of a buy and hold or an investor, because obviously you guys, you trade a lot less, and even though you're putting your positions in the exchange, that fraction of difference where we get filled is a loss for us, right? That's essentially, we're losing money, but they're making it. High frequency trading businesses, they make hundreds of millions of dollars a year. There's an exchange that actually is going to come out to make everything equal for everybody. And of course, the powers that be don't want to allow that to happen. The stock exchanges actually want high frequency traders because they provide a lot more volume. As I mentioned just a moment ago, there's reports that they provide more than 70%, more than 50%. I don't remember the exact number of the actual volume on the exchange. So every time that they make an order, buy and sell, that means that the exchange gets a commission. In true American capitalism, the exchange wants to make more and more money all the time. And what easier way to do it than to have robots that are automatically trading 100,000, a million times more than people like you and I that are analyzing the information and putting in an order, right? So there's even been exchanges in Mexico and Turkey that have invited high frequency firms to their exchange to be able to trade on their exchange. I know for a fact that Mexico now has 72% of all volume is high frequency traded. Eventually it gets to the point where the actual movement that you see in the market isn't really the normal movement that we're supposed to see, which is people buying and selling, but just high frequency trading algorithms that are literally just kind of buying and trading in milliseconds to be able to make just a little bit amount 100 million times a day. So let me know if you guys have any questions here on YouTube. You can visit the site daytradingacademy.com, and we'll talk to you soon. Ciao.